Investment. When people think about money, they often imagine that once you cross a certain number, life suddenly gets easier. And for many, that number is around $20,000. But here's the reality. Once you hit that point, everything changes. Invest, and in ways most people don't expect. At first, you feel like you've made it. You can cover rent, food, transportation, maybe even have a little extra. But that's exactly when lifestyle inflation sneaks in. You start upgrading things not because you need to, but because you feel like you finally can. Suddenly, the phone plan gets more expensive, the car loan seems manageable, and eating out becomes the new normal. That extra money you thought would build freedom, it gets absorbed before you even notice. And then taxes and real costs kick in. On paper, you're earning more. In practice, a good portion disappears the moment you get your paycheck. You climb into a higher bracket, your expenses scale up with your income, and you realize that an extra dollar past $20,000 doesn't stretch nearly as far as you thought it would. But here's the good news. Beyond this point, you finally have room to play the game differently. You're no longer stuck in survival mode. For the first time, investment, you can think about building credit, investing, or setting aside money that compounds year after year. And that's where the real change happens, not in spending more, but in putting your money to work. Most importantly, your mindset shifts. Before $20,000, money is about covering the basics: rent, groceries, bills. After that, it becomes about growth, choices, and the future. This is the stage where you decide whether that money will control you or whether you'll control it. So yes, and everything does change after 20,000, but not for the reasons people think. It's not about being rich. It's about realizing that what you do after that point, how you manage, invest, and prioritize will shape whether you stay comfortable or move toward real financial freedom. When most people start making around $20,000, there's a natural feeling of relief. It feels like a turning point where money no longer controls every waking thought. Bills are paid on time, groceries aren't such a struggle, and there's finally a little breathing room. But this is exactly where one of the biggest financial pitfalls shows up: the trap of lifestyle inflation. The moment people get extra income, instead of saving it or investing it, they raise their spending to match it. It starts subtly. You think to yourself, I've been working hard, I deserve something better. That might mean upgrading your phone, buying a newer car with monthly payments, moving into a bigger place, or eating out more often. At first, these changes don't seem like a big deal. You're making more, so you can afford more, right? But what actually happens is that every extra dollar you earn gets consumed by new habits. And suddenly the money that once felt like freedom doesn't feel like enough anymore. The trap lies in the psychology of comfort. Before 20,000, every purchase feels like a decision about survival. Do you spend on rent, food, or transportation? There's not much left after that. But once you cross that line, there's finally extra cash, and it tricks your brain into thinking you've leveled up. Instead of staying disciplined, most people let the new money slip through their fingers by raising their standards of living. What used to feel like luxuries become expectations. Eating out twice a week becomes normal, so now it feels like a necessity. Streaming subscriptions, gym memberships, online shopping sprees. Each one is small, but together they silently eat away at what could have been real savings or investments. Another hidden cost of lifestyle inflation is that it locks you into a cycle of needing more income just to maintain your new normal. When your car is fancier, your rent is higher, and your monthly bills have stacked up, you can't go back easily. Downsizing feels like failure, even though it's often the smarter financial choice. This means that the same person who once felt free at 20,000 quickly starts chasing 30, 40, or 50,000, thinking that the next level of income will finally solve everything. But the truth is, unless you break the habit of spending more as you earn more, no number will ever feel like enough. This is why so many people who earn well beyond 20,000 still live paycheck to paycheck. It's not that they don't earn enough. It's that they've let their expenses grow just as fast as their income. The real opportunity that comes with reaching this point isn't in buying more things, but in finally being able to save and invest in a way that can build wealth over time. If you resist the temptation of lifestyle inflation, even a modest increase in income can change your financial trajectory completely. But if you give in, you'll find yourself stuck in the same cycle of stress, just with sheenier things around you. When people reach the point of earning $20,000, investment, it feels like a breakthrough. For the first time, they can breathe a little easier, pay their bills without panicking, and maybe even treat themselves occasionally. That sense of relief is powerful because it marks the shift from constant survival to having at least some financial wiggle room. But right at this stage, a silent danger creeps in lifestyle inflation. It's the tendency to let spending rise in step with income. Instead of holding onto that extra money, it gets funneled into new habits, new comforts, and new expenses that don't actually bring lasting security. It often begins innocently. You might think, I've worked so hard, I deserve something better. That one thought justifies an upgraded phone, a newer car with a loan, or a slightly more expensive apartment. Dining out feels less like a treat and more like a convenience you've earned. Streaming subscriptions get added one by one. Gym memberships become standard, and small luxuries pile up until your paycheck feels just as stretched as before. What once seemed like financial breathing room is gone, not because your income isn't enough, but because your spending has caught up with it. The problem with lifestyle inflation isn't just the money leaving your pocket today. It's the way it reshapes your expectations. Once you've tasted that nicer car or that bigger apartment, going back feels impossible. Downsizing feels like failure, even though financially it might be the smartest move. That's how people get locked into cycles where every increase in income disappears as fast as it arrives. Suddenly, 20,000 doesn't feel secure anymore. You tell yourself 30,000 will fix it. Then 40, then 50. And yet, if the habit of inflating your lifestyle continues, the stress never leaves. This is why so many people earning well above 20,000 still live paycheck to paycheck. They don't have a spending problem in the sense of wasteful luxury. It's that their definition of normal rises every time they make more. That's the hidden trap. Comfort becomes the enemy of growth. Every upgrade feels deserved, but each one robs you of the chance to save, invest, and build real financial independence. The truth is, the extra income at this stage holds enormous potential if handled carefully. Instead of being swallowed by new expenses, it can be directed into an emergency fund, investments that compound over time, or debt repayment that frees up future cash flow. Avoiding lifestyle inflation doesn't mean denying yourself forever. It means creating space for your money to work for you. Investment, so that tomorrow you aren't still stuck in the same cycle of working just to keep up. That's the difference between looking rich for a moment and actually building wealth that lasts. Once you pass the 20,000 mark, a new reality sets in that most people never expect. Your money doesn't stretch the way you thought it would. On paper, the jump feels exciting. You imagine all the extra things you'll be able to afford, how much easier life will get, and how this new level of income will solve problems that once felt overwhelming. But then the hidden costs start showing up. One of the biggest factors is taxes. Before, your income may have been so limited that you barely noticed them. But now they start taking a noticeable bite out of every paycheck. The higher you earn, the more those percentages chip away. And suddenly the number you see on your offer letter isn't the same as what actually hits your bank account. At the same time, new expenses quietly creep in. As you earn more, you often move into a different bracket of responsibilities. Rent goes up because you want a safer neighborhood or a slightly larger space. Utility bills rise because your place is bigger or you use more conveniences. Owning a car may become necessary to keep up with your lifestyle or work, and with that comes insurance, gas, and maintenance. Even if you don't think you're overspending, these practical changes eat away at the difference. You thought you had a cushion, but it shrinks faster than you imagined. Then there's the psychological side of spending. At this stage, you feel like you have extra money, so you stop paying attention to the small details. Grabbing coffee on the go, upgrading your internet plan, subscribing to multiple streaming services, it all feels affordable. But those small decisions accumulate until you realize a big chunk of your monthly income is gone to things you barely notice. This is why so many people earning above 20,000 still feel broke. They underestimate how quickly recurring costs add up. There's also inflation in the larger sense, the price of goods and services rising around you. That extra income you're excited about doesn't exist in a vacuum. The cost of living climbs year after year. So while you're making more, everything you need is also more expensive. Groceries, healthcare, education, even basic household items. Each one steadily demands a bigger piece of your paycheck. Without realizing it, the margin you thought you gained disappears in the background of everyday life. What this shows is that earning past 20,000 isn't the guaranteed solution people assume it is. Yes, it provides stability, but the idea that money problems vanish after hitting this number is misleading. If you don't plan for taxes, adjust for hidden costs, and resist the urge to automatically inflate your lifestyle, the extra income won't move you forward. Instead, investment, it will vanish as quickly as it came, leaving you wondering why things don't feel different even though you're technically earning more. The truth is, it's not how much you make after that point. It's how much you keep and manage wisely that makes the real difference. Reaching and moving beyond $20,000 in income opens doors that were completely out of reach before. Up until that point, most of the money you make goes directly to covering necessities like food, rent, and transportation, leaving almost nothing to save or invest. But once you cross that threshold, and for the first time, you have the ability to think differently about money, not just as something to survive on, but as a tool that can grow and multiply over time. This is when opportunities for building wealth begin to appear. Investment, and the choices you make at this stage can shape the rest of your financial journey. One of the biggest opportunities that comes after this point is investing. Even small amounts set aside consistently can create a massive difference in the long run. With access to stock market accounts, retirement funds, or simple index funds, you're able to start compounding your money. For example, putting aside just a few $100s each month might not seem like much in the moment, but over years that money grows into thousands, and those thousands create returns that continue to generate even more wealth. Before 20,000, it's hard to even imagine having enough left over to invest. Afterward, it becomes possible, and that shift is powerful. Another important area that becomes available is building credit the right way. With a slightly higher and more stable income, you can responsibly manage credit cards, loans, or financing that improve your financial reputation. A strong credit history can save you thousands in the future by lowering interest rates on cars, homes, or even business opportunities. The same income that could vanish into lifestyle upgrades can instead be used to strengthen your financial foundation investment, giving you access to cheaper money down the line. This is also the stage where you can finally create a proper emergency fund. Having even 3 to 6 months of expenses saved changes everything about how secure you feel. You no longer panic over unexpected car repairs, medical bills, or job loss. That safety net not only protects you, but also gives you the confidence to make smarter long-term decisions because you aren't constantly living in fear of the next crisis. What's important to understand is that the wealth building opportunities available after 20,000 are not about sudden luxury, but about planting seeds. Every dollar invested or saved at this point carries weight because it buys you future freedom. Too many people waste this chance by allowing their spending to rise with their income. They focus on immediate comfort instead of using that extra money to create a financial engine that will keep working for them. The ones who do it right treat their income above 20,000 as fuel for growth, not just as fuel for consumption. Over time, investment. This discipline creates a gap between those who feel stuck no matter how much they earn and those who actually build lasting financial independence. Crossing the 20,000 mark doesn't just change your bank account. It changes the way you think about money. Up until then, income is tied almost entirely to survival. You're focused on making sure the rent is covered, food is on the table, and bills are paid before the month ends. Every dollar is stretched to its limit, and the idea of planning for the future feels unrealistic. Investment. But once you pass that point, something shifts. You're no longer counting every coin just to get by, and that freedom creates space for a different mindset, one that can either push you toward growth or trap you in cycles of spending. The biggest change is that money stops being only about survival and starts becoming about choice. You suddenly have the ability to decide what to do with extra income. That decision can lead to building savings, starting investments, or paying down debt. But it can also lead to buying more things, chasing temporary comfort, and raising your lifestyle so fast that the freedom you just gained disappears. The mindset you choose here determines whether your future will feel secure or stressful. Another shift is in how you view time. Before, money feels like it controls your time because you're constantly working just to keep the basics covered. Afterward, with even a little extra, you can think about how to use your money to buy back time. Maybe it means creating a side investment that grows passively or saving enough to feel confident about taking a calculated risk. Money at this level becomes a tool for creating options instead of just meeting obligations. It also changes your relationship with goals. When you're earning less than 20,000, your goals are simple: pay the bills, stay afloat, and avoid debt if possible. Once you move past that, your goals evolve into long-term visions. You start thinking about owning a home, retiring one day, or building wealth for your family. The shift is less about the number itself and more about the mental space that opens up once you're not constantly in survival mode. That clarity allows you to dream bigger and plan smarter. But the most powerful change is in identity. You stop seeing yourself as someone who is barely scraping by and start seeing yourself as someone capable of growth. That confidence builds momentum. You're more likely to learn about investing, explore financial strategies, and make disciplined choices because you believe you can. Of course, not everyone embraces this shift. Some people use the extra income to inflate their lifestyle and end up stuck again. Others realize that this is their chance to transform their relationship with money and build something lasting. The difference comes down to mindset, whether you treat money as a way to prove you've made it or as a tool to create a better future.